Imagine this, you have 100,000 in your bank account. You're staring at it, wondering, how do I turn this into something that can change my life? Maybe you've read stories about people striking it rich by buying the next Amazon or Tesla early, or you've seen someone brag about doubling their money in months through a hot stock tip. The dream of becoming financially free, retiring early, or simply having the security to live life on your own terms feels tantalizingly close. But there's a catch. The harsh reality is most people who try to pick individual stocks without the proper knowledge or discipline end up losing money. And yet, there's another path, a method quietly used by millions of investors that doesn't require timing the market, reading hundreds of company reports, or risking sleepless nights worrying if a stock will crash tomorrow. This method involves index funds, a way to invest that lets your money grow steadily over time while minimizing unnecessary risk. So the big question you're probably asking right now is, should you go for individual stocks chasing the dream of quick riches, or should you invest in index funds, playing the long game to steadily build wealth? Investment. This is not just a theoretical debate. It's a decision that will impact your financial future, your stress levels, and your lifestyle. One path is thrilling but risky. The other is steady but sometimes feels boring. And the truth is, both paths have their place, but only if you understand what you're really signing up for. Over the next few minutes, we'll break down the key differences, advantages, investment, and disadvantages of an index funds versus individual stocks. We'll talk about risk, returns, effort, and time so you can make a choice that aligns with your goals. Whether you're looking to retire early, generate passive income, or simply grow your savings safely, understanding these concepts is the first step to taking control of your financial destiny. By the end of this speech, you'll know which approach historically gives the highest probability of long-term wealth, why some people love the thrill of picking winners, and why others find peace in diversification. You'll leave with actionable insights and maybe, just maybe, a clear plan to turn your $100,000 or whatever you have today into a life-changing amount of wealth in the years to come. When it comes to investing, invest in an investment. One of the first things you need to understand is the relationship between risk and reward. This is the fundamental principle that separates successful investors from those who struggle to grow their wealth. When we talk about individual stocks, we're talking about putting your money into a single company, betting that this specific business will perform well over time. The upside is obvious. If you pick the right stock at the right time, your returns can be astronomical. Some investors have turned a few $100s into tens of thousands or even millions simply by holding the right company that experienced explosive growth. The thrill of these stories draws countless people into stock picking, promising the allure of getting rich quick. But here's the reality. For every success story, there are countless failures. Most people who try to pick individual stocks without proper knowledge end up losing money. Stock prices are influenced by a complex mix of factors, economic conditions, industry trends, competition, management decisions, and global events. Even the most carefully researched investments can falter if something unexpected happens. One day, everything looks perfect. The next, a bad earnings report or regulatory change can wipe out a significant portion of your investment. Now contrast that with index funds, which operate under a completely different philosophy. An index fund doesn't put all your eggs in one basket. Instead, it spreads your investment across hundreds or thousands of companies in a single portfolio. By mirroring a stock market index such as the S&P 500, you are essentially betting on the overall growth of the market rather than the fate of one company. The result is a huge reduction in individual risk. If one company in the index performs poorly or even goes bankrupt, the impact on your investment is minimal because it is offset by the performance of the other companies in the fund. Historically, over the long term, broad market index funds have tended to grow steadily, smoothing out the highs and lows of individual stock fluctuations. This doesn't mean index funds are completely risk-free. They still move with the market, but the odds of losing everything are extremely low compared to picking single stocks. Investment. Understanding risk isn't just about numbers, it's also about your psychological tolerance. Investing in individual stocks is emotionally taxing. You may wake up to headlines about a company in your portfolio facing lawsuits or sudden leadership changes, causing anxiety and impulsive decisions. Investors often sell in panic when prices drop, locking in losses that could have been temporary. Conversely, when a stock skyrockets, it's easy to get greedy and overcommit, exposing yourself to further risk. Index funds help mitigate these emotional swings. Investment, because they reflect the market as a whole, short-term volatility feels less personal. You're not watching a single company's fate dictate your financial future, which makes it easier to stick to your plan during downturns. Another crucial aspect of risk and reward is the potential for compounding. With individual stocks, compounding is unpredictable because the returns are highly volatile. A single bad pick can negate years of gains. Index funds, on the other hand, allow compounding to work reliably over time. Even moderate returns consistently applied over decades can result in substantial wealth accumulation. This principle is the reason why investors often say investment. Time in the market beats timing the market. The fewer the risks you take on individual stocks, the more consistent and predictable your growth becomes. Ultimately, understanding risk and reward is about making a realistic assessment of what you can tolerate and what kind of outcome you want. Individual stocks offer the excitement and potential for massive gains, investment, but with a high chance of losing your hard-earned money if things go wrong. Index funds trade off the thrill of a potential home run for steady, reliable growth and lower risk of catastrophic loss. If your goal is long-term wealth creation, managing risk is not optional. It's essential. By understanding the stakes involved in both approaches, you can make an informed choice that aligns with your goals, your timeline, and your emotional capacity for handling market swings. In investing, recognizing the difference between calculated risk and reckless gambling is what separates those who succeed from those who fail. Individual stocks carry the lure of high reward, but demand knowledge, timing, and a tolerance for risk that most people underestimate. Index funds, meanwhile, investment, provide a safer path that still allows for growth and the magic of compounding, making them the backbone of many long-term wealth strategies. Choosing the right approach begins with a clear understanding of these risks. And because without that awareness, no strategy, no matter how promising it seems, can reliably make you rich. Investing successfully is not just about choosing where to put your money. It's about understanding the effort and knowledge required to make those investments work for you. When it comes to individual stocks, the level of commitment can be intense. Every company you consider investing in demands research. Good investment. You can't simply buy a stock because someone mentioned it online or because it's trending in the news. To make informed decisions, you need to analyze the company's financial statements, including balance sheets, income statements, and cash flow reports. You need to understand key metrics like earnings per share, price to earnings ratio, and return on equity. Beyond the numbers, you must also evaluate qualitative factors: investment, the strength of management, competitive positioning, market demand, regulatory environment, and potential industry disruptions. This is a continuous process because markets and companies are constantly evolving. What looked like a strong investment last year could underperform this year due to shifts in consumer behavior, technological advances, or macroeconomic events. Without staying informed, you're essentially gambling. In addition to research, successful stock picking requires active monitoring. Unlike index funds, where the investment grows automatically with the market, individual stocks demand attention. You need to track quarterly earnings, press releases, mergers and acquisitions, and news that could affect the stock's performance. Investors often spend hours each week just keeping up with their portfolios. And even with all this effort, there's no guarantee of success. The stock market is unpredictable, and even the most diligent analysis can't eliminate risk. This combination of high effort and high uncertainty can be exhausting, especially for beginners or those who cannot dedicate significant time to investing. By contrast, index funds are designed to minimize the effort required while still providing exposure to the stock market. When you invest in an index fund, you're essentially buying a small piece of hundreds or thousands of companies at once. The fund automatically mirrors a market index, such as the S&P 500, which means you don't need to analyze individual companies, track quarterly reports, or monitor breaking news. The management of the fund handles all of this on your behalf. Investment. This hands-off approach makes index funds particularly appealing for busy individuals or those who do not have the background or interest in deep financial analysis. It allows investors to participate in the market's growth without dedicating hours every week to research and monitoring. Another advantage of index funds is their consistency. Because they are passively managed, And index funds typically have lower fees compared to actively managed stock portfolios. High fees can eat into returns, especially over the long term. And they are often associated with the frequent buying and selling that comes with managing individual stocks. With an index fund, your money is continuously invested in the market, compounding over time without you needing to make decisions about when to buy or sell. This consistency reduces stress, increases efficiency, and helps investors stay disciplined, one of the most important traits for long-term wealth accumulation. Effort isn't just about the time you spend. It's also about mental energy. Investment. Picking stocks can be mentally taxing because it requires constant decision-making. You need to decide when to enter or exit positions, how to respond to market swings, and which trends to follow. Emotional decisions, investment, driven by fear or greed, often lead to mistakes that cost investors money. Index funds, on the other hand, reduce the mental burden because they are diversified and track the overall market, and short-term volatility is less concerning, and the temptation to make impulsive trades is minimized. Investors can focus on long-term growth rather than reacting to daily market noise. Moreover, the knowledge required to succeed with index funds is far more straightforward. You don't need to memorize complex financial ratios or interpret quarterly earnings calls. You simply need to understand the principles of diversification, compounding, and market growth. This lower barrier to entry makes index funds accessible to almost anyone, from young professionals saving for retirement to people looking to grow wealth gradually without devoting a career to stock analysis. Ultimately, the choice between individual stocks and index funds often comes down to the amount of effort and knowledge you're willing and able to invest. Individual stocks offer potential high rewards but demand significant time, expertise, and continuous attention. Index funds, by contrast, allow investors to participate in market growth with minimal effort, making them a more sustainable and less stressful option for long-term wealth building. By understanding the difference in effort required, you can choose a strategy that aligns not just with your financial goals, but also with your lifestyle, schedule, and mental capacity to manage investments effectively. Investing isn't just about returns, it's about creating a system that works for you. Individual stocks require a high level of skill, dedication, and energy. Index funds require patience, consistency, and a willingness to let your money grow over time. By recognizing the effort involved in each approach, you can make an informed decision that maximizes your chance of long-term financial success while minimizing unnecessary stress and wasted time. When discussing investments, one of the most important aspects to understand is historical performance and long-term growth. This is where the distinction between individual stocks and index funds becomes especially clear. Many new investors are drawn to individual stocks because of the stories they hear. Someone bought a stock for a few dollars and sold it years later for thousands. Investment. Or another investor turned a small sum into a life-changing fortune seemingly overnight. While these stories are compelling, they are the exceptions rather than the rule. For every stock that skyrockets, there are dozens that underperform Nate, or even go bankrupt. The reality is that picking a consistently winning stock is extremely difficult even for professional investors. Historically, most individual investors fail to beat the market. Studies show that over long periods, the average stock picker tends to underperform broad market indices. This is not necessarily due to lack of intelligence. It's largely because timing the market, predicting trends, and reacting to short-term events is inherently challenging. Markets are influenced by countless factors: economic cycles, interest rates, government policies, investment, consumer behavior, and global events. Even the most diligent research cannot guarantee success because markets are not entirely rational, and prices often fluctuate based on sentiment rather than fundamentals. Index funds, however, have a track record that is both consistent and impressive. By design, they mirror the performance of a market index, such as the S&P 500, which represents a broad cross-section of major companies. Investment. Over decades, the S&P 500 has historically returned an average of 7–10% annually, accounting for dividends and price appreciation. While there are periods of decline, market crashes, recessions, and economic downturns, the long-term trend has always been upward. This long-term growth is where the power of compounding comes into play. Compounding is the process by which your investment generates earnings, and those earnings themselves begin to generate additional earnings over time. The longer your money remains invested, the more exponential the growth becomes. For example, An investment of 10,000 growing at an average annual rate of 8% will nearly double in about 9 years, quadruple in 18 years, and grow to over 100,000 in 35 years. One of the key advantages of index funds is that they allow investors to participate in this long-term growth without needing to select individual winners. Instead of trying to identify the next Apple, Amazon, or Tesla investment, you are effectively investing in the collective performance of hundreds of companies. While individual companies may fail, the overall market tends to recover and grow over time. Investment. This reduces the risk of catastrophic losses and increases the probability of steady, reliable growth. Another factor to consider is market timing. Individual stock investors often try to buy low and sell high, attempting to predict short-term price movements. This approach requires skill, experience, and sometimes luck, and even small mistakes can have major consequences. Index funds eliminate the need for precise timing because they are intended for long-term holding. By consistently investing in the market, either through lump sums or regular contributions, investors smooth out the effects of short-term volatility. This is often referred to as dollar cost averaging, where investing fixed amounts over time reduces the risk of buying at market peaks and ensures that you acquire shares at various price levels. Investment historical performance also highlights another critical point: patience beats impulsiveness. Investors who chase quick wins by buying individual stocks are prone to making emotional decisions, selling during market dips out of fear, or over-investing in hot stocks out of greed. Index fund investors, however, benefit from a disciplined, long-term approach. Even during recessions, when the market may fall 30% or more, those who stay invested often recover and continue to grow their wealth over the next decades. It's also worth noting that diversification, a key feature of index funds, directly contributes to long-term growth. By spreading investments across multiple companies and industries, index funds reduce the impact of any single company's poor performance on your overall portfolio. This diversified approach has consistently proven to produce smoother and more predictable returns over time compared to portfolios concentrated in a few individual stocks. Ultimately, historical performance and long-term growth illustrate why index funds are such a powerful tool for wealth creation. Individual stocks carry the allure of extraordinary gains, but come with a high probability of underperformance or losses. Index funds, by tracking the broader market, leverage compounding, minimize risk, and allow investors to grow wealth consistently over decades. The evidence is clear: patience, discipline, and market-wide exposure often outperform the gamble of stock picking, especially for those seeking sustainable long-term financial growth. By understanding the long-term performance of both approaches, investors can make informed decisions about where to allocate their money. While the excitement of individual stocks is tempting, historical trends demonstrate that a steady, diversified, and patient approach centered on index funds provides the best odds for building substantial wealth over time. It's not about chasing the next big win. It's about creating a reliable system that allows your money to work for you year after year, decade after decade. When it comes to investing, one of the most overlooked factors is psychology. Financial decisions are rarely made purely on logic. Emotions play a massive role in how investors behave. Individual stocks, in particular, put your emotional resilience to the test. Every price fluctuation, earnings report, or news headline can trigger strong reactions. Fear and greed are constant companions in the stock market, and they can lead even experienced investors to make costly mistakes. Fear may cause you to sell a stock prematurely during a temporary market dip, locking in losses that might have been reversed with patience. Greed, on the other hand, can push you to chase hot stocks, invest more than you should, or vest more than positions far longer than is prudent because you expect further gains. These emotional swings can have a direct impact on your portfolio's performance and your long-term financial security. Investing in individual stocks requires constant vigilance. You are not just monitoring numbers, you are monitoring your own feelings about those numbers. A small drop in a stock's price can feel catastrophic, even if the fundamentals of the company remain strong. Headlines about economic uncertainty, interest rate hikes, or geopolitical tensions can trigger panic selling. Many investors find themselves caught in cycles of overreacting to market news, which erodes returns over time. The psychological burden of managing individual stocks is often underestimated. You're not just investing money, you're investing emotional energy, and that energy is finite. Index funds, by contrast, help mitigate these psychological challenges. When you invest in an index fund, You are investing in the market as a whole rather than a single company. This broad diversification reduces the impact of short-term events on your portfolio. A single company's decline no longer feels like a personal disaster because your investment is spread across hundreds of companies. This allows you to view market fluctuations with perspective rather than panic. Over time, this perspective fosters discipline, patience, and the ability to stick to a long-term strategy, which are critical traits for wealth creation. Discipline is a key psychological advantage of index fund investing. The market will inevitably experience periods of volatility, crashes, corrections, and bear markets are unavoidable. Investors who hold individual stocks may be tempted to sell during these downturns, often at the worst possible time. Index fund investors, however, benefit from a passive strategy that encourages staying the course. By remaining invested even during tough market conditions, you allow compounding to continue working in your favor. This disciplined approach minimizes emotional reactions, reduces impulsive decisions, and increases the likelihood of long-term success. Another important psychological factor is the reduction of decision fatigue. Managing a portfolio of individual stocks requires constant analysis and choice. You must decide which stocks to buy, which to sell, and when to adjust your positions. This continuous decision-making can be mentally exhausting and lead to mistakes. Index funds simplify the process. Once you allocate your investment, the fund automatically manages the diversification and weighting of companies. You can focus on your life, career, or other pursuits while your money grows steadily in the background. This simplicity not only reduces stress, but also encourages consistent investing, which is critical for long-term wealth accumulation. Patience is another psychological virtue cultivated by index funds. Individual stocks often tempt investors with the promise of quick gains, leading to a mindset focused on short-term performance. This short-term thinking can be detrimental as it encourages frequent trading, overreaction to volatility, and chasing trends rather than sticking to a well-thought-out plan. Index funds encourage a long-term perspective. But the goal is not to make a fortune overnight, but to steadily grow your wealth over decades. This patient approach aligns with the natural growth of the market. Leveraging compounding returns while minimizing unnecessary emotional stress. Finally, the psychological piece that comes with index fund investing cannot be overstated. Knowing that your investments are diversified, passively managed, and aligned with the long-term growth of the market provides a sense of security and confidence. You're no longer obsessing over the fate of a single stock or trying to predict the next market trend. Then instead, you can focus on consistent contributions, long-term planning, and enjoying life while your investments work quietly in the background. In conclusion, investment. The psychological aspect of investing is just as important as the technical or financial side. Individual stocks test your emotions constantly, making it easy to make impulsive decisions that hurt your wealth. Index funds, by contrast, offer emotional relief, discipline, and the opportunity to remain patient, consistent, and focused on long-term growth. By reducing stress, limiting emotional decision-making, and promoting a disciplined approach, index funds provide a powerful tool for building wealth without sacrificing mental peace. For many investors, this psychological advantage is as valuable as any financial return, proving that investing is not just about money, it's about mastering your mind.